There's a chart that economists and traders check more closely than almost any headline, not because it's exciting, but because of its track record. It's called the yield curve, and when it flips upside down, it has preceded nearly every U.S. recession in the last 50 years. Here's what it actually is. The Treasury yield curve plots interest rates on U.S. government bonds across different lengths of time, from a few months out to 30 years. Normally, longer-term bonds pay a higher interest rate than shorter-term ones, because lending your money for longer carries more risk and uncertainty. That's the normal shape: short-term rates lower, long-term rates higher, sloping upward. An inversion is when that flips: short-term bonds start paying more than long-term ones. It looks small on a chart, but historically it has meant something big. The specific version most closely watched compares the 2-year Treasury yield to the 10-year Treasury yield. Going back decades, an inversion of this particular pair has preceded essentially every U.S. recession, not immediately, but typically somewhere between 6 months and 2 years later. Why does an inversion happen at all? It reflects investors expecting the economy to slow down. When bond markets anticipate weaker growth ahead, they expect the Federal Reserve to eventually cut short-term rates in response, so long-term bonds get bought up now, pushing their yields down relative to short-term ones. Here's the important nuance most headlines skip: an inversion is a warning signal, not a countdown timer. The lag between inversion and an actual recession has varied significantly across different cycles, sometimes under a year, sometimes closer to 2. And a small number of inversions in market history haven't been followed by a recession at all. That's why economists treat it as one important signal among several, not a standalone prediction. Other indicators, like unemployment trends, consumer spending, and manufacturing data, are typically watched alongside it to build a fuller picture. If you're not a bond trader, here's why this still matters to you. A prolonged inversion has historically been associated with tighter lending conditions, more cautious hiring, and increased market volatility in the following 1 to 2 years. It's a reasonable cue to review, not panic, about things like emergency savings, job security, and how much risk is in your portfolio. 3 things worth doing if you hear the yield curve has inverted. Don't treat it as a precise timer, it's a directional warning, not a calendar date. Check it alongside other signals like unemployment claims and consumer spending trends before drawing conclusions. And use it as a nudge to review your own financial cushion, not as a signal to make dramatic investment changes on its own. The yield curve doesn't shout. It's a quiet shift in numbers most people never look at, which is exactly why economists pay such close attention when it moves. We track the financial traps that don't make headlines, so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.